Hey everyone, welcome back to the channel. Today we're going to talk about Intel. If you're new around here, I wanted to quickly point out that you can follow along to any of my valuation videos. All you need to do is scroll down to the description and there will be a link for the model. You will need to make a copy of this model, but that will then grant you edit access so you can follow along and adjust my assumptions as needed. If you watched my recent portfolio review video, you know this is the only position I've held that's actually at a loss. I have a little over 101 shares at a cost basis right above $30. As of 6/14 at market close, I'm actually down $90 in total on the position. I originally purchased 100 shares, and with dividends, I've accumulated an additional 1.3 shares at this point. I point this out just so you know I do hold a position, so I am optimistic on my outlook for Intel, so keep that in mind with my DCF. I believe I've been fair with Intel, but I do hold a position, as I said, so I tend to make a more positive look at things more than likely. So before jumping right into the model, let's just quickly touch on Intel. They've been going through a sort of transformation over the last few years. I believe it was around 2022 when they first announced that they would be focusing on higher growth markets, and with this came the investments they're making into their Foundry business, as well as into their next generation chipsets. It was either in the Q4 23 or Q1 24 earnings, the CFO actually mentioned by 2026, the book value of the Foundry business would be around $100 billion. And we can actually see this. If you look at their balance sheet, we can see their property, plant, and equipment has actually grown from around 50 billion in 2018 to almost 100 billion by the year end 2023. So they have been on a path of significant investment over the last few years. They also are slated to release their next generation chipset, the Arrow Lake, by the end of this year as well. Intel has been on a bit of a turnaround mission, and these investments really show that. There's a ton of material Intel has actually produced and published on their investor relation website. I'll go ahead and pull through the ones that I read, and I'll link them in the description below. I'd highly recommend taking a look at it if Intel is a company that you're a little bit more interested in. So now onto the model. The Intel model was actually pretty straightforward. The hardest thing was truly the revenue assumptions. Intel recently actually provided updated modeling assumptions for both the gross margin and the operating margin, which makes our life really easy. And they provided this guidance back in April of this year at, I believe it was like an investor day. So let's quickly talk about revenue assumptions, then we'll go over the provided gross margin and operating margin assumptions from Intel. For revenue, they mentioned actually in a recent presentation that they anticipate the Foundry business to perform roughly $15 billion of revenue annually from outside companies by 2030. Something to note here is if you look at their most recent 10Q in the segment breakdown, they've included the full Foundry revenue, which is a little bit confusing. There is revenue included for manufacturing wafers for Intel products. They then add a line actually below this called inter-segment eliminations, which actually offsets the Foundry revenue. So if you net those two together, you'll actually get the revenue from outside companies. The estimate of 15 billion by 2030 that they have provided is excluding Intel revenue, so it would be the net of those two lines would be 15 billion. For the other product lines, it's a bit trickier to estimate. I mostly just took the Q1 24 results from a year-over-year perspective and extrapolated those out or held them flat. Intel has mentioned on multiple occasions that they're looking to get back to around a 10% growth rate, and my total revenue assumptions in my model end up getting us there in the next few years before we trail down to around 5% in 2030. So I think my overall revenue assumptions are actually pretty in line with things that they've mentioned. So this actually has the revenue going from 54 billion in 2023 to 117 billion in 2033. My assumptions have the client computing business growing from 30 billion to 66 billion, data center business and AI is going to grow from 15 billion to 22 billion, networking and edge growing from 6 billion to 10 billion, the Foundry business growing from just under $1 billion today to a little over 17 billion, and then all other revenues growing from 600 million to 1.7 billion in revenue. If you look at their most recent 10Q, it might actually be a little hard to reconcile to my numbers. I did not represent the entire Foundry revenue and then back out with any revenue elimination. I managed it the way they were previously reporting, with just the external revenue highlighted for the Foundry business. The recent realignment of business units has shifted some of their data center and AI revenue as well to their all other product lines. So if you look at their 2024 Q1, it's going to look a little different than the 2023 10K. And I'm using the 2023 10K representation. But now let's hop into the gross margin and operating margin assumptions. For their Intel product reporting line, which is made up of the client computing, data center and AI, and networking and edge business units, they're projecting gross margins between 50 and 55% and an operating margin of 30 to 35%. For the Foundry business, they're projecting a 15 to 20% gross margin and 0% operating margin. And all other, which actually includes Altera and Mobileye, they're projecting a gross margin of 55 to 60% and an operating margin of 25 to 30%. And this is for their midpoint estimates, which is around 2026, after they are finished with the majority of their investments into Foundry and their new chipsets. So quickly, for the long term, the projections they have for the Intel products, which is client compute, data center and AI, and networking and edge, they have the gross margin increasing from 57 to 60% with an operating margin of 37 to 40%. Foundry business is going to have a gross margin of 35 to 40% with an operating margin of 25 to 30%, so up from the 0% they have in the midterm. And then for all other, gross margin of 57 to 60 and an operating margin of 37 to 40%. So I rolled these into the model. When I layered these into the model, I built out schedules by business unit on the income statement tab that I've linked back into my model. For simplicity, I did not try to break down the difference between R&D and SG&A, but rather calculated total operating margin and actually use that as a proxy for our EBITDA. Intel mentions they expect total operating margin to be between 23 and 28% in the midterm and around 40% longer term. Our model actually does end up reflecting this with an operating margin of 30% in 2060 and then slowly increasing to 38% by 2030 before trailing off around 39% after that. I've assumed they will continue to have investments in capital expenditures, but it will slow down as a percentage of revenue. They mentioned 2024 will be the worst year for the Foundry business from a continued need to invest and a lack of revenue. But we have CapEx pulling back to around 12% of revenue from 50% of revenues in 2023. So we do see that decrease from investments in the Foundry business. So with all of these assumptions, here's what the financials look like. Revenues going from 54 billion to 117 billion, with EBITDA growing from $0 in 2023 to 45 billion in 2033. Cash flow is improving from a negative 22 billion to a positive 24 billion a decade from now. All of this combined, and we actually get a valuation between 115 billion and 307 billion, depending on the discount rate and perpetuity growth rate that you layer in. I believe this valuation truly does rely on you believing management and the turnaround. They have some tough margin expansions to hit, but if we go back to 2020, they actually did have a gross margin of 56% and an operating margin of 30%. So if these investments in the Foundry can actually make Intel product, like the Intel product business lines, more profitable from in-house manufacturing at scale, obtaining a gross margin around 60% with operating margins closer to 40% actually doesn't seem that infeasible. The big risk I see with Intel is any delay on the Foundry side. They put $100 billion of eggs in this basket. If for whatever reason it doesn't work out, Intel will suffer from that. However, I do like the longer term prospects of Intel. They're building a lot of manufacturing capabilities in the US and EMEA, and longer term, I think this is actually a very good strategic advantage. With the uncertainty between China and Taiwan, it takes a year of really rocky relationships for companies to switch their manufacturing somewhere safer from political risk. I'd imagine from a supplier diversity standpoint as well, if all your manufacturing is currently happening in Taiwan, you may want to diversify some of that and you're going to look for other options outside of Taiwan, and I think Intel could actually be a very good logical selection. So seeing their Foundry business grow from 15 billion in annual revenue doesn't actually seem that crazy to me. I think Intel looks attractive at the current prices, but once again, you really do have to believe in the turnaround and leadership. If you don't think it can be pulled off, then they clearly are overvalued. This model relies on those improved margins and a return to revenue growth. If the margins or revenue don't materialize, it's very hard to justify their valuation. I definitely recommend going in and adjusting some of the assumptions and see what the valuation changed to. But anyways, that's all I have for today. Leave any questions or comments below. Thanks so much for watching.